As we said, the premium isn't the only money exchanged in an option contract. There's also the strike price, the cost of the individual shares in an option contract. The strike is agreed on by the buyer and the seller at the start of every contract. In the call option example, the premium is the $100 fee that secures Arnold's right to buy the albums in B's collection for $10 each. The $10 is the strike price, or more literally, it's the price at which Arnold and B strike their deal for the individual records in her collection. In a call, the strike price is the amount the buyer agrees to pay the seller for the individual shares in the contract should they choose to exercise their rights. To calculate the total cost of the contract, you have to multiply the strike price by 100, the number of shares in the contract. Option strike prices come in 3 varieties: at the money, in the money, and out of the money. Each is determined by their relationship with the stock's current trade value. In the call example, B and Arnold agree that $10 is the correct value for each album in the collection. Now let's say that every record store in town has essentially the same inventory of albums, and they're also selling them for $10 each. That means $10 is the accepted current trade value of the records. If Arnold and B agree to a strike price of $10 per record, that number is considered at the money, because it's a strike price that matches the current trade value. To secure his right to buy her albums at $10 each, Arnold paid B the $100 premium, or $1 per record. But what if Arnold wants to secure the right to buy those albums from B for a strike price of $2 each? The odds he'd find buyers at that price is much higher than if he charged $10, because everyone knows they're worth more than what he's asking. As a result, recouping his entire investment is all but assured. That's why the $2 strike price is referred to as in the money. An in-the-money investment comes with a cost. In this case, B knows the trade value is $10 per album, so she only agrees to a $2 strike if Arnold pays a higher premium of $4 an album, or $400 total. Now, let's assume Arnold wants to buy each album for $50 even though they're selling for $10 in stores. B will accept a lower premium, say 20 cents a record or $20 total, because she knows Arnold won't find anyone willing to buy the records for $50 each when their value is only $10 a piece. Because $50 is so far above the agreed upon market value, it's considered out of the money. Arnold might pay a smaller premium, but there's more assumed risk, since it's going to be much harder for him to turn a profit on those records. In a call option contract, in the money is a low strike price, at the money is the current trade value, and out of the money is a high strike price. In a put, in the money and out of the money swap places. Let's see how that works. In our put example, B offered to pay a $100 premium to secure the right to sell Arnold her albums for $10 each. He accepted the terms because $10 is the universally agreed upon value of each record. This would be considered an at-the-money put because, just like an at-the-money call, the strike price is the currently accepted market value. Now imagine that when B struck the deal, she only wanted to sell the records to Arnold for $2 each. Arnold thinks that's a fantastic deal because the current trade value of the records is $10 a piece. As a result, he'll accept a smaller premium to secure the contract at $2 a record because the current trade value is much higher. For B, this transaction is an out-of-the-money put because the value of her current collection would have to fall drastically for her to exercise the right to sell the albums to Arnold for only $2 a piece. Likewise, if B suggested Arnold buy the records at $50 each, far beyond the generally accepted price, he's going to want a larger premium to assume that extra risk. That $50 strike price is deep in the money because B is almost certain to generate an enormous return on her investment if she decides to exercise her right to put those records in Arnold's hands for $50 each. In a put, in the money means a high strike price, at the money remains the current trade value, and out of the money is a lower strike price. That's kind of confusing, right? We get it. Think about it this way. Whether it's calls or puts, the premium increases as you get deeper in the money. The farther you get out of the money, the less a premium costs. There's one last part of an option contract to discuss: the expiration date.